controlling the construction company, we controlled the ability to build it at a price that was at or below replacement cost to most people. And what markets we chose to invest in, once again, it was driven by about 30 different criteria, but it was heavily weighted towards job growth and the diversity of employers in a certain market.
Welcome to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owners Association, where real estate investors have found success since 1968. I'm your host, Brian Hamrick from Hamrick Investment Group. This episode is sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. And RCB and Associates, helping real estate investors and small business owners navigate the complex world of health insurance and Medicare benefits at rcbassociatesllc.com. Hello and welcome to episode 411. There's a lot of speculation right now about the state of the real estate market and the outlook for multifamily apartments. Will we see a steep drop in value, or will sales pick back up once interest rates stabilize? My guest today believes that we will see a rise in demand for multifamily housing, and he's in a position to know. Garrett is the founder and CEO of the Garrett Companies, ranked as one of the fastest growing privately held companies in America. Since 1999, Eric has owned, developed, and delivered over 73 projects in 17 states, totaling over 16,000 units and in excess of $3.5 billion in valuation. Eric, welcome to the show.
Thank you.
Give us a little background on yourself. I mean, you've got a very impressive background. Tell us how you even got into multifamily and development and apartments and everything you're into now, and one of the fastest growing companies in the country.
I won't bore you with all the details. I'll give you the quick Reader's Digest version. But actually, out of college, I was planning on law school. And I won't get into all the details, but I was in a bar playing a game of pool and ran into a guy that happened to be in the real estate industry, and he kind of talked me out of law school. So that was the genesis of it. And I found my way to Chicago, where I worked for Marcus & Millichap selling apartments and brokered apartments around the Midwest. Had a lot of early success, just seemed to click, understanding how to put deals together, make transactions happen. And from that, my largest client was a family that was building multifamily, a prolific builder in the state of Indiana, that asked me to come on board and be his head of development. And at a really young age with no development experience, I said, sure, why not? Let's give it a try. And ultimately, that was the beginning of the development side of it, and crafted a method of finding markets that needed multifamily. And we were ranking every market in America with 250,000 people or more, and we ranked them based on about 30 different criteria that I came up with that I thought made a good apartment market. Anything from quality of life indices to job growth, rent growth, housing affordability gap, and so on and so forth. And ultimately, we were able to rank markets that we wanted to be in. And then we came up with a very select or very strict set of criteria for finding the right site once we were in that market. And it was a winning formula. And we ended up building 30 plus projects together and had some great success. And from there, created my own company in 2007.
Before you go on, when you were at Marcus & Millichap, you identified some metrics to determine where you wanted to actually build. And I'm assuming you were building new apartments?
We were, yes.
Why new builds and not buying existing apartments? And what made you determine what areas to invest in?
The new build question is the very simple reason was we just felt like there was a higher demand for newer product type. And we also felt like we could deliver that product type at or about the same basis that we could buy it at. So that's a crucial piece of this puzzle as well, is the control of cost. So by controlling the construction company, we controlled the ability to build it at a price that was at or below replacement cost to most people. And what markets we chose to invest in, once again, it was driven by about 30 different criteria, but it was heavily weighted towards job growth and the diversity of employers in a certain market.
What period was this, and what markets were you in?
This would have been from 2000 to 99 or 2000 to about 2007. And we were, Huntsville, Alabama, through the Carolinas. We were in Florida. We were in Tennessee. We were in really Southeast heavy. We had we moved out. The furthest west that we moved out to was Nebraska at the time, in the Omaha area. But so really, that was the general location.
All really good markets today. I'd assume they were probably up and coming in many cases at the time. And you were building into the Great Recession. Like, what was the outcome of that? Did you get out before? Did you get everything done before the Great Recession hit, or what happened at that point?
One of the key dynamics to what we do is we have to be able to build the project at a basis that allows us to get out of the project in good times or bad. So when times are good, obviously those profits are fantastic. Times are bad, they start dwindling away, but you're still making a profit, right? So by controlling that construction company and controlling that cost basis, we were pretty well insulated, even going into the Great Recession. And so, yes, we had great success in all the projects that we did. The tricky part of that particular market was not necessarily on the sales side of the project. It was actually the lease up side, the management side. And anybody that managed during that time period knows that you could lease 30 units in a project in a month and lose 29 of them to a single family home development where they were offering no money down, no credit check type mortgages. And those people would basically, what they did is they took good renters, they made them really bad homeowners. And then post recession, they came back and became really good renters again. So, that was a very difficult piece of the puzzle, was maintaining that occupancy rate. So finding those markets that were high growth, a lot of inward mobility into those markets allowed us to rent units, but that was a tough market to lease through.
So what was the next step? I mean, after you kind of moved on from that, where did you go next?
So in 2007, I created a company called Watermark Residential. And that came with a little hair as well. I mean, it was 2007, 2008. So, 30 days after I created the company, I think was when Bear Stearns collapsed. It was kind of the end of the world kind of scenario. So I quickly realized that even with the track record that I built, I needed a partner. We were going to have to partner up to get through that 2008 period together, and 2007. And so I teamed up with another group that actually came with a construction company. They didn't have any multifamily experience per se. They were mostly retail developers. But between their backroom operations and what they had put together and my track record, we were able to be really successful. And we built quite a few projects together. Once again, probably 20 or 30 projects together from really up to 2000. And, call it 2011-ish. So really quick run, a lot of projects together. And quite frankly, some of the projects that we put together in 2008 were the most profitable that I've ever done. We were able to step into the market when we really had no competition. And the availability of subs and materials was so, it was just easy compared to today. So that was a very good run. In 2011 or 12, I decided that I did not want to have partners, wanted to move on, hang my own shingle, created the Garrett companies, sold all my assets to my old partners and their investors, and went out on my own. And since then, we've done, once again, probably 50 or so projects. We have 20, and we also have 25 active projects right now around the country, and a pipeline of another 15 to 20 projects coming next year. So.
Wow. So very impressive. Like, what are you focusing on now? Is it all multifamily and apartments that you're building, or are you building other asset classes as well?
99.9% multifamily. And I throw in that little sliver there because we have a restaurant group as well. So we're doing some restaurants, but those are 100% for the benefit of our projects. Those are amenities to our projects more than anything else, more than a profit center, really. So we do build some restaurants as well.
What metrics are you using now? Like, how are you deciding, say, where to build, what markets to be in, the type of product to build? What's your outlook or thought process there?
The program hasn't changed. We're very boring when it comes to that. We found a system that works, and we continue down that path. And so we're still looking at the same, it's changed a little bit. It's not 30 criteria now, it's 27 criteria, but we're still looking at the same criteria ranking markets. We still have the exact same site selection criteria. When it comes to product type, it really varies by location, but I will say that we are very streamlined. We have 4 different product types that we build, and that's it. We're not trying to build a brand new piece of art every project that we do. And we do this for a variety of reasons. One, we're trying to control cost, and control some of the uncontrollables that you have in construction business. But those products are very nice. So we typically do either a 2-story or a 4-story product. It's kind of our bread and butter, not 3-story. Everything we do is elevator served, except for the 2-story product, obviously. Most of that 2-story product has an attached garage, which is direct access. So it lives more like a condo than it does a traditional multifamily project. The 4-story product, it's heavily amenitized. You're typically looking at, institutional quality finishes, anything from thick quartz countertops and 42-inch cabinets and tile backsplash, tile surrounds in your showers, hardwood floors throughout. So, very high-end product that tends to lease fairly well.
You do 2 stories or 4 stories, but not 3 stories. Why not 3 stories?
We made the decision that in a 3-story product, the 3rd floor while it's commercially acceptable, and there's nothing wrong with 3-story product, the 3rd floor is always hard to lease. And it always was back, when we were traditionally doing that type of product. And we realized by bringing in an elevator and by going to 4 stories, we gain more density so we can afford the elevator at basically the same cost that we could 3-story breezeway product. So if there's no cost difference and you're able to provide elevator service, and now somebody who is, say, 55 and older that wants to live in a traditional apartment complex, they can now do that. They have the option to live on any floor they want without having to worry about stairs. So when we go into the market, our renter base it's a wide demographic range across the board in terms of age. And we like it that way. Obviously, more people that can walk into that project and lease it, the better. The better the numbers are, the easier the lease up is. So,
how many units in each project? Like, what's your range there?
We typically say minimum of 200 units. Our average across all projects is about 250. But we have done some 150 unit projects and we've done some 300 unit projects, but call it a 250 average.
If you were to kind of give us a typical layout, is it one building with 250, 300 units? Is it multiple buildings? What is it? How much acreage does it take up? And what are the configuration of the buildings?
So in our 2-story product, we're roughly, call it 17 to 18 units an acre. So in our 4-story product, we're typically 30 plus units an acre. So, and we're traditionally in more than one building. Our 4-story buildings are typically courtyard buildings, or they're U-shaped or they're L-shaped. 100 units is about not the maximum, but about the size of a typical building. So if we're doing a 200 unit project, you may have maybe 3 buildings, 250 units, maybe 3 buildings on, call it, 7 acres, give or take, depending on setbacks and, detention and obviously parking requirements or whatever else locally might come up. So
your site selection is very important to you, and you definitely have some metrics that you look at there. What are some of those metrics, and what makes a site buildable for you?
Without going into all the details, I'll say, and keeping some of that in our back pocket, I'll say that some of the key criteria, and these are going to sound very basic, but you may or may not be surprised how many people really stick to a set of criteria like this. In our experience, a lot of developers look for the easy way. They look for a site that's zoned maybe, and they could care less if it's 3 intersections away from the growth. But if it's zoned and ready to go, they want to jump on it. We, on the other hand, take a lot of time and a lot of risk, in some cases, rezoning a project if we have to, and downzoning a project if we have to, in order to get the site that we want. Would typically, if you're going to pinpoint it, if you can picture where a Super Target or a high-end grocery anchored shopping center would go, or a Whole Foods, we're probably somewhere in that general area. So we're looking for high traffic counts, easy access into the site. We're looking for brand new or newer retail. We're looking for high-end housing, clean housing more than high-end. We're looking for school systems that are strong. And most people ask, okay, so do you plan on having a lot of kids? No, that's not necessarily the case, but school systems tend to drive submarkets. So, even if you do not have a kid, typically people go and they rent in areas that they see themselves growing into. They see their kids going to that school system. They see themselves stepping into that submarket, that strata. That's where they want to be. So it's just another indicator of the market.
Right now in today's market, because I'm doing some development as well, and we're looking at other projects to work on, but it's very hard to get it to pencil out because it's just with higher interest rates, higher costs for materials, supplies, labor, things like that. It's become very difficult. How are you able to pencil out on your projects? I mean, in the past, when interest rates were super low, it was a lot easier. But are you having to really kind of sharpen that pencil these days?
Land cost is probably the biggest issue I'm seeing right now. And I'll explain why. So interest reserve, we have room in our deals that we can grow interest reserve to cover ourselves and make sure everything is going to be taken care of through the construction period. Yeah, that's definitely an increase. I mean, which once was a $2 million interest reserve is now a $4 to $5 million interest reserve. So it's a lot of money, obviously. But we build it, and it's such a cost basis that most of our competitors cannot compete with it. And a lot of that's driven by volume, but also it's driven by, a variety of other things. Not only how we've managed subs throughout the past and how we've grown those relationships, but we also have some of our own internal subs. We have a framing company, we have plumbing and HVAC, we're in the process of acquiring a drywall paint company. We have a company called Apex Materials, which is buying materials directly from the source. We have no wholesalers, no middlemen. We're trading lumber with this on the CME. So we're buying futures, we're hedging that bet. We're buying lumber directly from mills, not through suppliers and wholesalers. So we gain a lot of competitive advantage by doing that. It's not the easiest way to go about the business. And it's probably not the safest way, but it certainly paid dividends.
I'd like to take a moment to tell you about Green Property Management. Not only do they manage everything from single-family homes to apartment complexes in the West Michigan area, they also manage my entire portfolio. So I can tell you from personal experience that their unique flat fee management style is worth a closer look. If you feel that your property isn't operating to its fullest potential, then Green Property Management can help you take a holistic approach that will save you money, eliminate your headaches, and increase your net income. And if you're a property manager interested in applying Green Property Management's model, give them a call at 1-866-95-GREEN or visit them on the web at greenpropertymgt.com. If you're thinking of leaving your W-2 job and becoming a full-time real estate investor, one of the greatest costs you must consider is healthcare for you and your family. When I made this transition myself, I found the whole healthcare insurance process to be confusing and frustrating. That's why I'm glad I met Chad Creasy at RCB & Associates. Chad is a professional health insurance agent who helps real estate investors and small business owners understand and choose their best healthcare options. And best of all, his services are covered by the insurance company and won't cost you a dime. If you live in Michigan and are expecting a change in your healthcare insurance coverage for any reason, or losing employer coverage or transitioning into Medicare, then you owe it to yourself to contact Chad Creasy at rcbassociatesllc.com. What's your outlook on multifamily, though? I mean, right now, I know if you look across the country, there's what is it, like 1.5 million units coming online. So in some markets, it's going to be way oversupplied for at least another year or so. But that's really just 2/3 of the top 20, the top 20 markets, which is 2/3 of where all that's coming online. What are you seeing in your markets as far as demand, and what makes you bullish on multifamily still?
A couple of things. Number one, I think, once again, this is based on kind of some of our internal research. It's based on discussion with a lot of professionals, and it's based on just how they have derived what they believe the pipeline looks like. And what we're seeing is that we believe the deliveries that are being touted right now are not going to be at that number. We believe that it's going to be about half of that or less. And a lot of that's driven by the fact that there are, and I can tell you that just in the last, I'll say this, in the last month, we've been presented with 7 projects that we can go do that are shovel ready with permits in hand. So there are a large numbers, and that's just in one submarket. There are a large number of projects that have been permitted by some of the largest clients that are part of the largest institutions you can think of that typically would have no problem getting a job off the ground, and they're walking away from the projects. So we're seeing a lot of that in our small world.
Why are they walking off the projects? What is the dynamic there that's causing that?
Well, it could be a variety of things. If they are if they're raising money from institution that does not feel comfortable with the market right now, or they have a lot of issues with redemptions and they're giving money back and providing money back to investors because they're scared of the market right now. That's happening quite a bit. And they can't get their construction costs to come in line. The days of calling a third-party GC and saying, hey, come build this project for me, and I need to be at this number, that doesn't exist. They're going to go out and they're going to bid it, and they're going to try to make a strong margin, and they can kind of control that market right now. So, if you're dependent on a third-party GC to do your project, that can be tough to get your deal to pencil. So a lot of these guys just cannot wrap their head around why they take Denver, Colorado, for example. Most institutional groups are telling me that their replacement cost in that market right now is somewhere around $320,000 to $330,000 a unit. That replacement cost is for a project that's probably 900 square foot average apartment. So without giving all the details, I can tell you that we could build a 1,000 square foot average apartment with the exact same finishes at a substantially less number than what they consider replacement cost. So that's the competitive advantage that we have. So when they're stepping into a deal and they're saying, okay, I can buy this, build this, take all this risk, invest all this capital and build a project for $330,000, or I can go buy a project down the street that's 5 years old for $330,000 right now with interest rates where they are. Why would I build? And that's the question that all these guys are asking in their boardrooms. Whereas we are looking at it and saying, okay, we still have substantial upside by building this project. So we'll take over the project, no problem. And we'll even reimburse you for your architectural, and we'll take the plans as is and we'll build the project. Now, back to the original question at hand, though, these guys are walking away from jobs. They're not getting built. Yes, they've pulled permits in some cases, or they're ready to pull permits, and that gets included into the total of units being delivered or expected to be delivered, but it's not necessarily reality. So I believe the reality, and once again, this is just all opinion, I think we're moving into a market where the deliveries are not going to be, in most markets, are not going to be as strong as what we expect. Now, obviously, there are quite a few cranes in different cities. I mean, if you go to Atlanta or to Houston right now, this doesn't play out because those markets have quite a few projects being built. And, that's it. They're going to have some short-term supply issues. But for the most part, general swath, most of these markets are not going to have the supply that's expected. The housing affordability gap has continued to grow. I mean, interest rates and borrowing costs for the single-family home buyer are completely out of control. Very few people are going to actually buy a home. That leaves one place for people to move to, and it's traditional multifamily. And if the supply is lower than expected, and we were already below where we needed to be to meet demand before, supply comes down back into 500,000 or half of what we think it's going to be because of this permitting and borrowing cost. Housing affordability gap keeps growing because of interest rates continuing to grow. Yes, multifamily borrowing costs will increase, but I think we're on path for a very rapid increase in rents over the next 2 years, which is not a good story based on inflation and the pressures that they're trying to control right now by raising the Fed rate. I don't see any way around it. From my point of view, I see this as being we've penciled in a 10% increase in rents next year, and it wouldn't surprise me. And we're already seeing some of that. We have no concessions right now. We're still pushing rents.
Would you say that's purely a supply and demand reason? Because the increase in rents, there's just not enough supply to meet the demand of people who need housing. Is that really what it comes down to?
I think so, because a lot of the in-migration has slowed quite a bit. I mean, for example, Denver, the Denver metro still has some job growth, but it's not what it was. And we're still not seeing the number of, U-Hauls going into the Denver metro as we were 2 years ago. Yet the demand for our product type continues to increase. And I think it's just natural household formation coming into the market, not having a place to go buy because housing cost is so expensive there, coupled with interest rates. So they're moving into multifamily. In some cases, they're moving into what I consider trendy downtown multifamily for a short period of time, realizing that there's really no reason to pay $3,000 or $4,000 a month for a 800 square foot apartment in downtown Denver when you can live 20 minutes away in a suburban infill location for half that cost. So we're seeing a lot of that flow from urban to suburban still. But yeah, I think it's supply and demand driven. And that's, we're pretty heavy in the Front Range right now from Colorado Springs down to or up to Fort Collins. We're heavy in Florida right now, Arizona. And we're seeing that same story play out through all those markets.
You're seeing like heavy increases in rents over the next couple of years. Like what do you see in 5 years? Are we going to be able to meet demand in 5 years, or is this just going to be a continuing supply demand issue for those who are looking for housing?
I think it'll be a continuing issue. I think that for those like myself that like free market solutions to problems, I think that unfortunately, it looks like we're heading down a path where there's going to be some type of a rent control, would be my guess, would be the next step from a federal level. I think there are better ways to solve that problem. What
would rent control mean to you as a developer and builder? Would you keep going, or would that maybe put a pause on what you're doing?
It really kind of depends. We're still, as much as I continue to talk about, our rent growth and what we're able to rent things for, we're still not, our typical project is not too far above what I would consider workforce housing, kind of that 100% to 120% of AMI. So that's kind of our target range anyway. So I don't know that rent control will have, from a rent standpoint, will not have that huge effect on us on projects that we build and lease and keep. Now, where it does factor in is there's going to be this learning curve. And anytime you introduce a learning curve into a market like, investment real estate, it hurts values. So you may end up with a case where, you may end up with a case where you see some values take a short-term hit, even though rents and everything else and the pro forma still hold steady, and from a long-term hold standpoint will be fine. But you may have a short-term hit when it comes to trying to sell something. Now, we're kind of seeing that right now, right? I mean, you've got, rates are increasing, values are coming down as a result of that because people are trying to solve for the same cash flow that they were trying to solve for before. So, which is nearly zero, which, a whole other side topic. But, so if you're trying to buy a 5 cap and, the 10 years at 4, well, that's not if that's what you're solving for from a cash flow standpoint, when rates go to, when 10-year goes to 4.7 or whatever it is right now, that obviously has a negative effect on the value. So, so we're seeing this lease up that's going strong, rents that are achieving everything that we had imagined and then some. Yeah, we have some expense issues with some inflationary issues. Insurance, for example, is a big one, but some other things that cost a little more than we expected. But it's all kind of balancing out to a really nice pro forma. But it's not translating into really what it could be if rates were a little bit lower on a sale price. So sets up really nicely for a long-term hold.
I'm hearing you say the cash flow is good with the increase in demand and rents, but the values are being impacted by higher cap rates, higher interest rates.
Keep in mind too that, we actually, I've got some, some real life examples. We sell a lot of projects every year, and, where we were selling projects in Denver, for example, let's take Denver, the Denver metro, call it 2 years ago, a year ago, is not dramatically different than the pricing that we're getting back on whatever projects we're on the market for right now. So yes, the days of saying I'm going to go build a project in Denver and sell it for 400,000 a unit, that was never real anyway. That was a over exuberant buying market with rates near zero and capital flowing in from everywhere. So I never really looked at that as reality. So if that's your benchmark, if you're deciding you're going to go in the Denver metro area and you're going to build a garden property and you got to get 400 a door to make it work, probably not reality. But if you went into the market saying, okay, I'm going to build this at a great basis, we're going to have a very well underwritten product that we know that we can hit the pro forma, and we need to achieve a 300 and call it 20,000 a door or more price in order to return a great return to our stakeholders and everybody else. Then it's not that bad of a market. It's the problem is that a lot of guys got lured into the market at a basis that doesn't make sense.
A lot of great insight from you on what's going on in the market right now. As we wrap it up, Eric, I always like to ask my guests, what is your favorite hack or app?
Unfortunately, I'm not sure that I have either.
What app on your phone can you not live without?
I can't even think of one app that I have that I use on a routine basis. Maybe my 10B2 calculator app.
Tell us about your 10B2.
For a long time, I carried around my old trusty calculator still, and all the younger guys in the office made fun of me because they're doing all of these amazing things in Excel and everything else. And I traded in the calculator for the app because it's the exact same thing, but that's still today how I put together a pro forma, and then I hand it to the guys and tell them to do whatever they're going to do with all their fancy if statements and everything else in their Excel sheet. So,
Eric, why don't you tell our listeners how they could find out more about you or get a hold of you, and feel free to plug whatever you'd like.
It's thegarrettco.com. It's a pretty robust website. You can get to all of our various entities there, anything from our restaurant group to our sub base to our Tellus Capital, for example, which is a new private equity firm that I partnered in. And, we're providing general partnership capital to multifamily projects across the country. We're not only providing capital, but we're also providing a lot of the services that we provide to the Garrett companies. So if you need a partner for a capital side of it and maybe some balance sheet enhancement, and then also would like to see how accretive our cost basis is, it's a pretty good package. We can provide a really good solution for guys that deals just don't quite pencil right now.
What markets are you in?
We've worked in 17 different states, a lot of different markets, but really, if you said cut the Northeast off and then everything east of Phoenix, Arizona, and Denver, we've played in those markets.
Thanks so much for coming on the show. It's been really interesting learning about your early history leading up to the Great Recession of building up like 35 different projects, ground up construction of apartments, how you pivoted afterward. And now you've got the Garrett Co. and, just really killing it on the apartment front. And I love hearing about how you are able to kind of meet the challenges of the day with higher interest rates, higher costs for supplies and labor, because you've figured out some really solid ways to get around paying some of those costs that other competitors are paying. So really interesting conversation. Thanks so much for having it with us today.
Well, thanks for having me. I appreciate it.
I want to thank everybody for listening to this episode. I'm your host, Brian Hamrick from Hamrick Investment Group, and you can find out more about me by going to higinvestor.com. That's HIG investor.com.